Hello, good morning, students. Welcome back. How are you all? So, today will be the last lecture of partnership firm, accounting for partnership firm. Mono sir is going to guide you all. And sir ने एक request है यार, थोड़ी सी नाराजगी भी है कि आप अपने जो कमेंट्स है फीडबैक है वो आप हमें शेयर नहीं करते, तो वी आर नॉट वेरी मच हैप्पी फॉर। अगर आपको पसंद आए लाइक कर दो, पसंद नहीं आता है तो डिसलाइक कर लो, कमेंट्स कर लो। दैट इज वेरी इंपॉर्टेंट सो दैट वी कुड गेट एनालिसिस एंड फीडबैक मिल जाए। तो आगे से ध्यान रखो कि जो भी आपकी राय है, ओपिनियन है, फीडबैक है, प्लीज पोस्ट करते रहना। दैट विल इम्प्रूव एंड इंक्रीज आवर मोटिवेशन एंड हमें और अच्छी तरह से काम करने के लिए और मोटिवेशन एंड इंस्पिरेशन मिल जाएगी। तो गुड मॉर्निंग एंड लेट्स वेलकम द लेजेंडरी सीए डॉक्टर मनोज गुप्ता जी। ओवर टू यू नाउ। गुड मॉर्निंग सर।
Good morning, sir.
जय श्री राम।
Friends, before starting, there is one doubt that today lecture is applicable for CA inter new syllabus. So that is not applicable for new syllabus. Okay. And before it, sir, I want to share the screen. Mr. K, sir.
Yes, sir. Yes, sir.
So share my screen, please. Perfect. So today lecture mainly for CA Foundation and CA IPCC new syllabus. Okay. Before starting, yes. Yes, friends. Yes, friends. Good morning once again. Now, friends, before starting, just tell me the homework. I hope homework is done by everyone, right? Homework has the mainly thing is a fair notebook, right? Whatever we had did yesterday, the previous lecture, and the remaining question you have to try, right? So I hope you had tried and you had done the question as well as, right? Now let's come to the next part. We had discussed about proportionate capital yesterday. You all know, yes, that proportionate capital is nothing but the capital which is same as in profit sharing ratio, right? So for which we had discussed that how to convert our capital in our profit sharing ratio. So for that we will do some sum, and the concept we had already discussed yesterday, right? Also friends, we want to do the next sum where I think there is a new profit sharing ratio are there, because we had did one sum for the profit sharing ratio, and next sum whatever the sum just we do. Okay, I just open the question. You also open module from student section, ici.org. If you have your module, then definitely use that only. I'm using CA Foundation module. Okay. So partnership, we had did introduction, treatment of goodwill, and now admission is going on, right? So in admission, we had solved I think question number, which question we had solved last? I think we had solved last question, question number 5, right? Yes. So now question number 6. And also we had not read notes yesterday, means last lecture. So now we read all notes also, right? So today we read notes also for the introduction. Introduction I think read. Admission will read the notes, admission and for goodwill. Okay. So today we read the notes also. Let's start. Question number 6. A and B are in the partnership sharing profit and loss in the proportion of 3/4 and 1/4 respectively. Means their ratio is 3:1, right? Their balance sheet as on 31st March 2016 was as following. Okay, cash 1,000, trade receivable 25,000, inventory 22,000, plant and machinery 4,000, trade payable 12,000, bank overdraft 15,000, is capital 15,000, B is capital 10,000. So these are the opening balances given in the balance sheet given in the statement form, means in para form, not in the proper form. So we can make the opening balance sheet so that we can cross check whether this balance sheet is tally or not, right? So if you want, you can make the balance sheet on this basis, right? On 1st April 2016, they admitted C into partnership on the following terms. Okay, they had admitted the C. So you see the new partner. C to purchase 1/3 of goodwill for 2,000 and provides 10,000 capital. Goodwill not be appear in the books. Perfect. So what he say? He have to purchase 1/3 of the goodwill for 2,000. Means 1/3 of goodwill is 2,000. That means how much? 100%. So we can calculate the full goodwill. And goodwill will not appear in the books. That means goodwill should not shown in the books. What is this concept? Actually, I told you the beginning. Goodwill is extra earning capacity of the firm, but goodwill is good for the firm only when it is not shown in the books. Like when any person say, I am this, on that time his goodwill get written off. But others say, you are this, then your goodwill is there. So in your books, in your mouth, you should never say something good about you. You should always think that you are humble, you are doing your work. So that is only the value of the goodwill. Then only the value of the goodwill. That's why goodwill should not shown in the books. If it is shown in the books, it is not good intimation. Okay, so here also mention appear goodwill should not appear in the books. बहुत अच्छी बात है, will not appear in the books. Appear goodwill in the books. But caution, we should be very careful whenever goodwill is shown in the books. They intimate the position of that business is not good. Okay, so we should be very careful. We should not show goodwill in the books, right? Further, profit and loss are to be shared by A, B, and C equally. Okay, so in future the profit sharing ratio is ABC equal. Okay, plants and machinery is to be reduced by 10% and 500 to be provided for estimated of bad debts. Inventory is to be taken at a value of 24,940. Okay, so these are the revaluation of assets and liabilities. Okay, by bringing in or withdraw cash and capital of A and B are to be made appropriate to that of C on their profit sharing basis. So this is the main part which we had discussed yesterday also in last lecture also, that they want to make their capital in proportionate. So just you see the proportionate word, capital in proportionate, you should understand that capital and profit sharing ratio should be same. So profit sharing ratio they had mentioned that is 1:1:1 in the after admission of C. So their profit sharing ratio is 1:1:1. It means their capital should also same. And for that they had considered C as base. So C on their profit sharing basis. So C's capital is 10,000 subject to any goodwill adjustment. So after that we can find whatever the C final capital, that C capital is considered as a base for remaining partners capital, and that's become balance carried down in the capital account, and whatever difference in the capital account will be transferred either in cash account or maybe in current account. They may be inform us. If they not inform us, we transfer into cash account. Okay, because they had intimation that withdraw cash and capital means they had withdraw the capital amount. So whatever extra amount they had withdrawn, right? Then go ahead, set out entire to be above arrangement in the firm journal and give the partners capital account in tabular form. So they say we want partners capital account in tabular form and want journal entry for these transactions. They don't want the balance sheet. So no need to prepare opening balance sheet, because if we prepare opening balance sheet, then we have to find any balance, anything remain. But only if we want to prepare closing balance sheet, means after admission balance sheet. But they had not asked after admission balance sheet, so we will not prepare opening balance sheet also. Okay, because in exam we don't have the time doing extra thing. Mainly whatever they had asked, we have to complete that, right? So mainly capital account they had asked, so start the capital account. Answer to question number 6. What are the page number, friends? .66, right? We prepare only capital account which is prepared in columnar form. He had also mentioned in columnar form only, but with proportionate capital concept. Okay, and I think all you know about proportionate capital, because we had discussed in last lecture. Their capital should be same in the ratio as their PSR, right? It is called proportionate capital. So we'll write first balance carried down and brought down both, right? But balance brought down will be based on some capital. They had given C capital as a base, right? So we make the first format by balance brought down, because A and B are already partner. Their capital is A capital 15,000 and B capital 10,000. So 10,000 and 10,000, right? So now go ahead further. What they say, they admit C and he bring 10,000 for capital, but 1/3 of the goodwill for 2,000 and provide 10,000 as capital. Goodwill is not appear in the books. So C purchased 1/3 of the goodwill for 2,000. Means he had paid 2,000. So in this case, what we should do, 2,000 is paid by him and 10,000 paid for capital, right? So what we do, we just pass entry for this transaction, right? What they say, C to purchase 1/3 of goodwill for 2,000 and provides 10,000 as capital. Means 12,000 he will bring overall. So what entry we can pass? Cash bank account debit to C capital, that is 10,000, and whatever he bring for goodwill, that will be shown in capital A and capital B in sacrificing ratio, right? So overall 12,000 he bring, 2,000 for goodwill he purchased, and 10,000 for capital. Now 2,000 we will distribute among partner in the sacrificing ratio. So note, calculation of sacrificing ratio. How to calculate? New old ratio minus new ratio, right? Sacrificing ratio equal to old ratio minus new ratio. Now A old ratio is how much? 3/4, right? So 3/4 minus new ratio is what? 1/3, because all three partners are equal now. So 9 minus 4 upon 12, 5 upon 12, right? Then B capital is also 1/4 minus 1/3, 12, 3 minus 4, negative 1 by. It means what? We have not sacrificed. We are the gaining part. So A will get from B as well as from C. How much from C? Just we come on to the C part. What is the C share? 1/3. That means for 1/3 he is bringing 2,000. Then B share is also 1. So for that he also have to bring some part of capital, some part of goodwill, right? So A will get from B as well as from C for goodwill. Now how B will get, or how we will bring in the for goodwill? So B may be considered it in cash, but it will adjust it through capital automatically. Okay. So now what we do? We just calculate whatever sacrificing ratio and whatever gaining ratio. So B and C are in the gaining ratio, right? B and C are in gaining ratio because first old ratio of B is 0 and new ratio is 1/3. So it means he's entitled, or he have to bring 1/3 of negative share, right? So his capital is also negative 1/3. Is it clear, all of you? So now A will have to bring, and B and C, no, A will get and B and C have to give. Clear? Just wait, friends, for a minute.
ये ना ये देखो ये
Yes. So now we had calculated the sacrificing ratio and gain ratio. Now we will make how much C should bring, how much B should bring, because B is the existing partner, he is gaining partner. So for that, either we can do through capital account or we can do through cash, because they say that capital should be in proportionate. That means if capital is proportionate, so automatically whatever difference they will bring in cash. So we can do it through capital account also, right? So what we do, first we complete this transaction, bank account debit to C capital 10,000 to A capital 2,000. Because B will bring, not get anything. So first this complete, this entity complete, B capital to C capital. Then through capital account we will adjust C share also, right? B share also. Oh, sorry. So now, how much we have to bring? So we have to bring 1/12, where C have bring for 1/3 2,000. Then how much for 1/12? Right. So either you can convert it into 12 only. So it is converted by 4 by 4, right? So 4 by 3, 4 by 12. We can multiply with same figure with both sides, no problem. That means C is bringing for 4 2,000. Then we have to bring for 1 how much? Cross multiply 2,000 into 1 divided by 4, that is 500, right? So we have to adjust 500. How we can adjust? So we can debit B capital account to A capital account by 500, so that B is also gaining partner, he will bring also something. Is it clear, all of you? Perfect. So now we'll put this information in the capital account by bank account A 2,000 and C 10,000, by B capital account in A account 500 to A capital account in B 500, so that adjustment through capital account. And whatever difference will come, they will automatically adjust it by cash bank. They had intimated us, right? Next, C had purchased. एक मिनट. हाँ जी, good morning. हाँ जी. एक्चुअली बेटा अभी मैं क्लास में हूँ, मेरा वेबिनार चालू है. So you call me around 5:30. Okay. Yeah, sorry friends. So now what they say, C purchased 2,000 for goodwill and 10,000 for capital. That is clear. Now furniture further profit and loss are to be shared equally. That is also okay. Plant and machinery is to be reduced by 10% and 500 to be provided for estimation of bad debts. Inventory is to be taken over, evaluate at this much. So for that we have to prepare revaluation account also, and they have asked general entry, so general entry also we have to prepare, right? So what we can do, we can make the one revaluation account as a working note, because they are not asked, na? So tell me how we should provide. Plant and machinery to be reduced by 10%. How much plant and machinery? 4,000. It's reduced by 10%. That means 400. So 2. It's a loss, na? Plant and machinery 400. We'll pass entry from that ledger only. Directly we can pass the entry. One entry only we can pass. Then and 500 to be provided for estimated bad debts. So 2 bad debts, or you can say debtors, 500. Next, inventory is to be taken at value of 24,940. How much inventory value? 22,000. So it's increased by 2,940. 2,940 by inventory. How inventory increased? 24,940 minus 22,000. You're in the value. You're in the books. Then next, by bringing in or withdraw cash and capital of A and B are to be made proportionate to that of C on their profit sharing ratio. That is a proportionate capital we have to do, right? So revaluation part is done. And there is no reserve also. Trade receivable, inventory, plant and machinery, payable, overdraft. So these are normal balance, nothing balance, reserve is there. If reserve is there, that is also distributed among partner, right? So now, revaluation entry you will also pass. What entry we should pass? Revaluation account debit. Because it's debit, so debit side. 2. Plant and machinery. 2. Bad debts. So 400, 500, and this is 900. Second entry, inventory account debit to revaluation 2,940. Right. Now whatever the net profit will be transferred to partner's capital account. You can calculate the net profit. $2,040.2 net partners capital account we had mentioned already. Only you have to write A and B. AB. A share is 3 and B share is 1. Old PSR, right? 2040 divided by 4. 510 into 3. 1530. Right? So that entity will be revaluation account debit to partners capital account, partner A, partner B, 1530 and 510. 2040 Now in partners capital account we write credit side by revolution account 1530 and 510. Okay, so this is revolution also done. Now what we should do, we have to make capital in proportionate. So we write to balance carry down, and for that we make working note. For that first we have to close C, because C capital is the best. So 10,000 is C capital balance. We had directly written 10,000 only. 2,000 we had transferred to A capital because he bringing for goodwill, and for goodwill entire sacrifice by A only, right? So 10,000 we had given to A only. Now what we have to do? We have to calculation of working note for proportionate capital. Okay, calculation of proportionate capital, PC, proportionate capital, right? How to calculate? They had said that 1/3 C share is 1/3. For that he bring 10,000, right? Therefore total capital should be 10,000 into 3. That can be distributed among A, B, C in their new PSR, that is 1:1:1 only. So 10,000, 10,000, 10,000. Is it clear? So 10,000 each we will get balance. So first we write balance 10,000. Then whatever balance remain, because this is not balance, this is balance calculated. Now whatever balance remain, that will be transferred to cash bank. Maybe they will bring, or maybe they will get it back, right? So just check. So I think he will get it back, and he will also get it back. How much? Take the total and find the balance. 0, 2, 4, 5, 9, 19,030, right? And this is 10,510, 10,510, and this is 10 only, right? This is 9,030. So that much cash they will get back from the business, right? Because they have to withdraw to make their capital proportionate. Now all partners are equal partner, that is 1:1:1. So their capital should also 1:1:1. So that capital is 10,000, 10,000. That's why balancing figure is different. That is, we had transferred to cash because they say they had withdrawn. They had withdrawn that in the cash. So 9,030 and 10 they withdraw, and the future capital is 10,000, 10,000, 10,000 each. So their profit sharing ratio and their capital become same. All of you understood, friends? Because profit sharing ratio and capital both are same, then it's known as proportionate capital that we had discussed yesterday also. And I'm again repeating, their capital and their PSR both are the same ratio, that is called proportionate capital. Okay, so clear, friends? Any doubt, any question, please ask. No doubt? Okay, go ahead. Next part, we can check this answer also if they had make the capital. Yes, he had withdraw cash 9,030 and 10, and their balance is 10, 10, 10 each. Okay. Next, let's issue number 7. A and B were partners of X and company, sharing profit and loss in the 3:2 ratio between themselves. Okay. On 31st March 2016, the balance sheet of the firm was as following. This is the balance sheet given. Capital AB, trade payable, plant and machinery, furniture and fixtures, inventory, trade receivable, cash in hand. Okay. X agreed to join the business on the following condition as and from 1/4/2016. Okay. So the date of balance sheet and the date of admission are same, only 1 day difference, right? So there should be same date. If suppose sometime the date is not same, then first our objective is to get the balance sheet as on date of admission. That's why you see normally admission part or admission date are same as balance sheet date. Even retirement date also same. Only death date will not same because of death is not in our hand, right? Okay, we go ahead. He will introduce 25,000 as his capital and pay 15,000 to the partners as premium for goodwill for 1/3 of share of the future profit of the firm. So it is same as question number 6, right? The adjustment. He introduce 25,000 for capital and 15,000 for premium of goodwill, right? For 1/3. That means we can calculate the total goodwill also. Next, a revaluation of assets of the firm will be made by reducing the value of plant and machinery to 15,000, inventory by 10%, furniture and fixtures by 1,000, by 1,000, and by making a provision of bad and doubtful debts at 750 on trade inventory. So these are the revaluation part. Prepare profit and loss account, adjustment account, capital account of partners, including the incoming partner X, assuming that the relatives ratio of the old partners will be in equal proportion after admission. Okay, that means what? Last line is very important. First they say prepare profit and loss adjustment account. Actually that is not profit and loss adjustment account, that is actually revaluation account. Okay, so whatever revaluation they had given, we have to revalue all assets and liabilities. Next, capital account of partner including the incoming partner X. Okay, so capital account, it is nothing but capital account. Assuming that the relatives ratio of the old partners will be in equal proportion after admission. That means old partner will now share equal ratio. That is 1:1. Previously they have 3:2. 3:2, right? Yes, 3:2. But now their ratio will be same as equal. So what do you mean by equal ratio? That means 1:1. So new ratio will be 1/3 of new, that is C, and there also 1/3, 1/3, because assuming that the relative ratio of the old partner will be in equal proportion after admission. So equal proportion means they are become now equal partner. Okay, so I think it's very easy sum, but still we do because this is something ratio only they had mentioned at the end in the different way. Otherwise everything is correct, right? So I think no need to do, because it is same as previous question only, and there is no proportionate capital also. So we just make the revaluation account, we just make the partner's capital account, and then we can prepare the balance sheet if they ask, but they had not asked the balance sheet. They had asked only the P&L adjustment account. There is nothing but revaluation account and partner's capital account, where new partner capital is equal. New ESR is 1:1:1. But that is not a matter, because they don't want their capital in proportionate. There is nothing, nowhere is mentioned their capital should be in proportion, right? So you can do in the homework, nothing is special, right? So in the future, capital is also not equal because they not say proportionate capital, right? Only goodwill part we have to adjust. That is, whatever he bringing for goodwill, that should be adjusted in sacrificing ratio, right? That sacrificing ratio is nothing but old ratio minus new ratio, right? That new ratio is 1/3, 1/3. Right? You can see also this is 1/3, 1/3 is the new ratio, right? And here both are sacrificing. Previously, one are the gainer and another are sacrificer, but here both are sacrificing, right? Next, question number 8. AB are partner with capital 7,000 each. Okay, They admit C as a partner with 1/4 share in the profit of the firm. Okay, C bring 8,000 as share of capital. Give the necessary journal entry to record goodwill. Nowhere has mentioned the goodwill amount, but they say give necessary journal entry to record the goodwill. Because one line question, there is nothing about the goodwill, but that is the hidden goodwill we are already discussed, right? So we write the one note on hidden goodwill so that you will also get the note, right? Before it, we write question number 7 only, na? Same you can do in home, right? Now question number 8, hidden goodwill concept. So I told you last time also, hidden goodwill is nothing but we calculate the value of capital on the basis of new partner and compare with total capital. The difference you will get as a goodwill, right? So what we can say, total proportionate capital less total actual capital, proportionate capital on the basis of new partner, right? Less total actual capital including new partner capital. Then whatever the difference will be considered hidden goodwill, right? So this is a note also. We have the note in our notes also when we read the notes. Don't worry. So we had written proper notes also. But still you should understand hidden goodwill is nothing but the value of capital on the basis of proportionate less actual capital including new partner capital. So the difference is goodwill. So in present case, if we see answer to question number 8, page number is 8.69. Right? So now what we do, C enter in the business for how much share? For 1/4 share. And capital is 8,000. Therefore, total proportionate capital should be 8,000 is for 1/4. How much total? That is 32,000. Less actual capital of A plus B plus C. They mention A and B each have the capital 7,000 each. So 7,000 plus 7,000 plus 8,000 comes to 22,000. Therefore, hidden goodwill is how much? 10,000. Right? Now, what the treatment of hidden goodwill? So, C will bring for his share how much? So, she share in goodwill 10,000 into 1/4. That is, he bring 2,500. Is it right? Right? Because 2,500, 10,000 divided by 4, it's become 2,500. So she share for goodwill is 2,500. Is it clear? Very good. Now what we do? She share will be sacrifice, means she share will be getting by the sacrificing partner, right? So we can write C capital account debit to A capital to B capital. In what ratio? In the sacrificing ratio. And nowhere has mentioned that how A and B sacrifice. So we consider their in their PSR. And what is their PSR? The PSR also not given. Old A and B profit sharing ratio is not given. So we assume it's also same. That is 1:1. Right. So they will sacrifice 1:1. So 2,500 we can divide into 1:1. That is 1,250. Right. We can write being adjusted entry for goodwill pass, right? So this is the adjusted entry. C capital account debit to A capital to B capital. C capital 2,500, A capital, B capital credit by 1,250. We are assuming that profits and ratio of A and B are same, equal, right? Okay, let's see what they had did. Yes, they had did also same thing. A capital, B capital, and C capital 10,000. T capital goodwill share is 1/4 of 10,000. Is it clear? Okay, next question. 9. A and B are partners sharing profit and loss equally. The balance sheet of Messrs A and B as on 31st March December 2016 was as following. Okay. Capital A and B, trade payable, sundry fixed assets, inventory, bank. Perfect. On 1/1/2017, they agreed to take C as 1/3 partner to increase the capital base to 1,35,000. Okay, means they had they're ready to accept C as new partner, and after new partner admit that capital base is 135, C agreed to pay 60,000. So the necessary journal entries and prepare partners capital account. So they want journal entry as well as capital account. So friends, first of all, we should identify that 1/3 partner to increase the capital base 135 means their capital base they want to maintain at 135, but C bringing 60,000. That means capital base is 135, but C bringing 60,000 for 1/3 share. That means there's some hidden goodwill also, right? So first we do the hidden goodwill treatment. Answer to question number 9 or the page number 8.70. Right. Hidden goodwill treatment. Right. C share each 1/3 and capital, and he bring 60,000. Therefore, total capital, or you can say total capitalization value, 60,000 into 3, 1,80,000. Less actual capital base. What they say? Actual capital base is 135 only. Given the question of 135. Therefore, hidden goodwill is equal to 45,000. Right? So hidden goodwill is 45,000. Now that goodwill should be bringing or adjusted. How to adjust? Either we can adjust only for C or we can adjust entire. So let's adjust only for C. Therefore, C share in goodwill 45,000 into 1/3, that is 15,000. So C capital account debit to A capital to B capital in their sacrificing ratio. What is sacrificing ratio? So C admit for 1/3, and previously they share equally. That means after that also they are equally. So everything is equal only. So 1,500 they will bring, they will get sacrificing in equal ratio. That is 1:1. Okay. Now C had bringing, so bank account debit to C capital, he had bringing 60,000. So these two adjustments are the main adjustment, right? Now their capital base is 135. That means capital of ABC should be in their proportionate, right? So now what we do, we make the partner capital account. How to prepare partner capital account? Particular for the partner name AB and they admit C. A, B, C. Particular A, B, C. Right? First balance brought A 45, B 45. Right. By bank, C bringing 60,000. To A capital to B capital, that is for goodwill, this 7,500, 7,500. By C capital, 7,500. Right? Now, they want their capital base 135 to 2 balance carried on 135 in the equal ratio. So 135 divided by 3. 45,000 each. $45,000 each. So their balance carried down is 45,000 each. Is it clear? Perfect. Now balance we had find already, and so the general entry we had already passed. Prepare the partners capital account. So partners capital account is ready. Now what are the balance? Either we can transfer to current account or we can transfer to cash bank account. We'll transfer to cash bank account. So it's finished, right? So 45 plus 7,500, 52,500, right? $52,500. 7,500 they will bring in back. Means they will withdraw. This is also 52,500. 7,500 they will withdraw. This is 60, and I think this is also balancing figure. Nothing balance. Okay. So now this is the capital account, and balance sheet they had not asked. If they ask balance sheet, then we can make a balance sheet also. And for that we can pass the entry. They had withdraw the capital. So what entry we can pass? A capital account debit, B capital account debit to cash bank 7,500, 7,500, 15,000. Perfect. That's all. Now next. Yes, they had also withdraw 7,500, 7,500. That's all. So now friends, the test your knowledge question, you can do your own. There is multinational means MCQ also, multiple choice question, as well as some practice question also. Now make the heading, new heading, that is retirement of partner. That is unit 4. As per our, it's a part 3rd. Right? Retirement of partner. Any question, any doubt you can ask. First, till here. No doubt. Okay. So 2-minute break. Yes, friends. Retirement of partner, right? Friends, after admission, definitely sometime partner want to retire from the firm also, maybe due to any reason. Now, when he admit, he bring for goodwill, he bring for capital. Now, in same way, when he retire, he will withdraw his capital, he will withdraw his goodwill. Means he will get for goodwill, he will get for his capital. So, firm have to pay to that retiring partner. Now, question: how firm will pay? So, if firm have cash, then he can pay immediately. Otherwise, maybe remaining partner will get money for payment of retiring partner, or maybe that retiring partner capital we can transfer to loan account, right? So, in short, friends, when any partner goes out from the firm, that is the case of retirement, right? Now, in case of retirement, what we do? So, we have to find how much capital we have to giving to retiring partner, who will get or who will gain the share of retiring partner. Because previously, suppose you had three partner, you distributing one chapati in three part, one third, one third, one third. Now, only two partner remain. One partner retired from the partnership firm. So you have to distribute that one chapati among both only. That means retiring partner share will gain by remaining partner. That gain may be in the same proportion as they are previously PSR, or maybe in the different proportion also. So normally in the existing proportion only. In this case, what with the new ratio? New ratio is only we cut the, say suppose A, B, C are partner, C are retired. That means A and B will be the remaining balance of PSR, will be their new PSR. So for gaining ratio and for new ratio in case of retiring partner is not big task. But still, suppose they had given that the retiring partner share will bought by partner A only. So whatever share of C who is going to retire, entire the share will be added in each A profit only. Okay. So normally caution is silent about who will bring or who will gain the retiring partner's share. So we assume they gain in their old proportion, and whatever the existing ratio will remain same in new ratio only. Whatever retiring partner, that ratio will be scrapped. Okay. So in this case, again we have to do same thing as we do in case of retirement. In case of admission, means the accounting treatment are same as we do in case of admission. That is, we have to prepare evaluation account, we have to prepare partners capital account, and we have to prepare the balance sheet as well. Okay, so all treatment, everything are same as admission of partner, except here retiring partner will get fund from the firm for his capital, for his goodwill, and his share will be bought by remaining partner. If question is silent, we consider they had bought in their existing proportionate of PSR. That's why new PSR will be same as previous, that is existing PSR, except the retiring partner PSR. But if they specified that retiring partner PSR will be get by remaining partner in some proportion, then that proportion we will add in the old ratio. So their new ratio will arise. Okay. Now friends, for that also we have the notes, because treatment are same. We have to prepare evaluation account, we have to prepare partners capital account, we have to prepare balance sheet. So everything are same. That's why we just read the notes, as we have not read the admission part also, goodwill part also. So just starting the reading of notes from beginning, from admission until retirement. Because in retirement nothing is special. Only retiring partner will get money instead of he bringing money, right? Like in admission case, new partner is bringing money, for firm, but retiring partner will get money from the firm, either by paying remaining partner, or maybe it can be transferred to loan account. Okay, so now I come to the that notes part which we read, right? So all concept get clear, because we had not read the notes from admission, right? So let's start the reading. Till what we had complete. Rule for interest on drawing. Yeah, rule for interest on drawing already we had discussed, and I think we had also read, right? Rule for drawing, rule for interest on drawing we had already done, right? Treatment of goodwill in partnership account. Now read from here. So just read once all notes, so that whatever we had discussed, that we have written, because when we study hard, we study good way, you even understood everything, but still in future you need to revise these things. For that we need notes, so these notes are for that only. Goodwill means extra earning capacity of the firm, that is, if A and B both doing the same business, and A is earning ₹100 and B is earning 120, and B earned ₹20 extra because of his goodwill. Understood? So goodwill is nothing but extra earning capacity, that is they earn because of, tell me, they earn because of their extra earning capacity, because of their goodwill. So whatever extra earned, that is earned because of his goodwill. Now what it should not be shown, yes, but it should not shown in the books, because goodwill is an intangible assets which may have value or not. We should calculate only for the purpose of admission, retirement, death, or any change in the business. But we should not show goodwill in the books. Remember, we should never ever show goodwill in the books. If shown in the books, it is intimation that business condition is not good. You should not go for that business, because as I told you, that your goodwill, if others say, then it is your goodwill, but your goodwill, you say that I am this, that means you don't have any actually. Understood? So this is the goodwill meaning. Now how to calculate goodwill? It is based on the past profit, right? It is based on the past profit, but calculate expected future profit which can be earned because of goodwill. Means it's based on past profit, but we calculate on the basis of expected future profit, because of which we are paying the goodwill. So we earn extra in future, that's why we are paying the goodwill. So our objective is to calculate expected future profit, right? That is called future maintainable profit, FMP. We calculate goodwill on the following 7 steps. That 7 steps we had discussed, you remember. Average profit is step number 1, right? For goodwill valuation, we had discussed in the last lecture, right? But notes we had not read, that's why we are reading notes here. If it continue increasing trend, then we should take the weighted average profit. Higher weight for higher profit, that is recent profit. Any abnormal loss or profit will not be included, right? Because we have to include normal profit only. So it's the average normal profit, and profit is increasing trend, then we should take the weighted average profit, right? All these things we had discussed in last lecture. Future maintainable profit, that's expected future profit, which may have any expected future charge, like manager become partner, then we say salary of manager in future. So our future maintainable profit will increase by, not increase, reduced by manager's salary. Reduced by manager's salary, right? Because in future, no need to pay, we have to pay salary to manager, right? Like what to say? Have any expected future changes, like manager become partner. Okay. It's a manager become partner. It means they saying manager become partner, so no need to pay salary to manager. So it's a correct. Profit increase, not decrease. So profit increase, friends, they are correct. because they say, read again, manager become partner. So for future, we will not pay salary to manager. Reason now he is partner. So that is the saving of expenses. So our profit get increased by manager salary. If nothing is mentioned, then average profit itself is the future maintainable profit. Right. Step 3, capital employed. Capital employed, that is partner's capital. Total include current account also, means whatever capital they had employed for the business. Right. That is called partner's capital employed. Step 4, normal profit, cost of capital. Normal profit is that much profit anyone can earn, and that is the cost also for acquiring the fund, right? That is n percentage given, that is the account capital employed into rate, means whatever the normal profit percentage, that is called normal profit, that is cost of capital or opportunity cost, right? Super profit. Super profit means extra profit to be earned, that is future maintainable profit less normal profit, right? That we had already discussed. Just we are reading the notes, so that whatever we had discussed, everything is in the notes only, right? So that you not have any confusion. Now, number of purchasing year, it means the profit of goodwill will continue for how many years, right? If it is given in the question, we use that. Otherwise, we assume 3 years, right? That is number of purchasing year, right? Question 7, final goodwill. Method, average profit method, that is future maintainable profit into number of purchasing year. Future maintainable profit you get from step 2, right? And number of purchasing year you get from step 6, right? Then super profit method, super profit into step 6, right? Okay, friends. Now super profit you get from step 5, multiply by number of purchasing year, that is step 6, right? So step 5 into step 6. Next, annuity method, that is super profit into annuity factor. Capitalization method, super profit upon capitalization rate, right? Then capitalization method we can calculate by other way also, FMP divided by capitalization rate minus capital employed. So both things we can calculate the goodwill, right? Then they had given some example. We had already question. Now comment which method we should use. So we can say if we want to calculate more goodwill, then we can use average profit method. If we want to use less goodwill, then we can use annuity method. But the best method is super profit method, because under which we get extra profit, and even we should multiply with annuity factor so that we get the time value of money. Or means consider time value of money also, right? So best method may be anything as per the company situation. But if we want to make goodwill higher, then we should use average profit. But if we want to reduce the goodwill, then we should use annuity method. Is it clear? Okay. Which method we should use if we want to pay higher goodwill, and for higher goodwill we should follow average profit method, right? Because in average profit method we get the maximum goodwill. But why we should pay entire amount which we earn profit? We should pay only for extra amount, that is super profit for goodwill. That is super profit method, right? But if we consider the value of money also, then we should pay only annuity method goodwill, that is lower amount of goodwill. Annuity method is a lower amount of goodwill. Clear? Okay, so they had calculated the goodwill on some method. Now treatment of goodwill. We had also discussed this. Treatment of goodwill means how the goodwill will be distributed among partners. So it means how it will be recorded goodwill in the books, our books, in case of admission, retirement, and death. of the partner. So in case of admission, retirement, death, all case the treatment of goodwill mostly are same, but we discuss a little bit when we discuss the next topic, the retirement of partner. So goodwill will be raised with the old partner, including retiring partner, but write off with the balanced partner, that is excluding retiring partner, right? For that we should know ratio concept, right? So for treatment purpose, we have to know the ratio concept, because it's sacrificing ratio goodwill is given to the sacrificing partner. We have to calculate new ratio, we have to calculate old ratio. So these ratio are calculated here. We had already do some for that, right? But still, you just read this ratio: profit sharing ratio, old PSR, new PSR. So these are the three ratio: profit sharing ratio, old PSR, and new PSR. So this ratio we had calculated. Sacrificing ratio or gain ratio is equal to old ratio minus new ratio. Gain ratio equal to new ratio minus old ratio. So in case of retirement of partner, we calculate the gain ratio, that is old ratio, new ratio minus old ratio. This one. See? Okay. How to calculate new ratio in case of admission? Example we had taken. Example A and B are partner 2:1. C admit for 1/4 share. So they had calculated the goodwill on all cases, right? We had already done this sum. So that is new PSR. Next, A and B are partner sharing 5:3. Admit C a new partner for 1/5 of share. Find out the ratio. So this is again the example of the finding of new ratio. So we had did this. You can also do again it if you want. Goodwill can be bought by new partner in cash. Then we pass following entry. That is 2 entry we had passed, but net entry will be cash account debit to A capital and B capital, because first cash account debit to goodwill. So goodwill is debit, credit, and next entry goodwill account debit to old partner in old PSR, right? In sacrificing ratio. That is old partner in sacrificing ratio, right? So goodwill we can cancel. So net entry will be cash account debit to partner A to partner B, that we had passed, right? Next, cash account debit to old partner capital account in sacrificing ratio, that is the net entry. You can say this is the net entry. You can pass anyone. Note: goodwill should be bought by gaining partner, new partner, and should be given to the sacrificing partner, that is partner is sacrificing ratio, right? That is old partner. If goodwill is adjusted through partner capital account, in this case, suppose if goodwill is adjusted through partner's capital account, it means what? Goodwill account not bringing by partner, by the new partner, but we adjusted through capital. That means we make the working note. Remember, by working note we calculate the net, whatever account debit or credit, and we can pass the one entry, common entry for the goodwill adjustment. We had passed many times, right? We just did in the notes for this. In this case, we will make working note in such a way that gaining partner debits with goodwill amount and sacrificing partner credited with goodwill amount in his capital in adjusted for goodwill, right? So that is goodwill raise, goodwill write-off we had did, right? Fine. Again, so next entry, next adjusted entry, C capital account debit to A capital to B capital, means C will be sacrificing and C is the gaining partner. Now admission of partner, where we have written the whole concept, that is revaluation account, partner's capital account, and balance sheet we have to prepare. So what we made admission, they had mentioned all these things here. Let's read this part also. When we want to expand, when we want to expand our business, we will admit new partner in this case. We want to expand our business, we will admit new partner, right? In this case, new partner will bring for goodwill and capital, and old partner value all assets and liabilities at current value, right? So old partner revalued, right? And whatever revaluation, profit or loss and whatever revaluation profit or loss. Right? On revaluation will be distributed among all partner in old PSR. Perfect. Okay. Accounting treatment. We have to make accounting treatment for goodwill, profit sharing ratio, which is already done. Right? We have already done goodwill treatment and PSR also in previous chapters, and we have to make following ledger, that is revaluation account, partners capital account, and balance sheet after admission. Right? Revaluation account is just like a P&L account where we write all profit or loss on the valuation and distribute it to the old partner in old PSR. Right? Partners capital account is as usual, and balance sheet again as usual. Now revaluation account, it is just like a profit and loss account where we include all assets and liabilities. Revaluation in profit, revaluation in profit, credited side, write the credit side, increase assets and decrease the liability, right? And loss in the decrease, loss that is decrease in assets value and increase the liability value, right? And it will be transferred to old partner capital account in old PSR. Clear? That is the format revaluation account, particular amount, right? Then increase in assets value, decrease in liability value. In the same way, decrease in assets value loss and increase in liability value over loss. Note, if they ask journal entry, then passing from account, we can pass from account because we have learned journal entry to ledger and ledger to journal entry. Both way we can go, right? Memorandum revaluation account, same. When partner want to maintain their assets and liabilities at book value, but they want to provide the effect of change of the revaluation in partner's capital account. Then we prepare memorandum revaluation account. First H, normal evaluation. Okay, so here we pick the comma. Account. First H, normal revaluation account. Then opposite of revaluation account. Profit and loss will be distributed in all partner in new PSR. Right? We had discussed this also. Memorandum revaluation account we prepare when assets and liabilities you want to maintain at the same value as they are. Right? Then further, this is the example given. Now proportionate capital. This is also we had discussed and we had just solved the problem in this lecture only. Proportionate capital means when partners want to bear capital in their PSR, right? In this case, closing balance, that is partners capital account, closing balance, we calculate first and then balancing figure may be transferred to cash account or maybe partners current account, right? That is partners capital will be in same ratio as PSR. So that PSR and partners capital account ratio will be the same. Clear? Now this is the question we had solved. Now hidden goodwill treatment also there that we had discussed at the last. If new partner brings some higher amount as capital and nothing is mentioned about goodwill, then we consider different amount, that is extra amount, compared to capital as goodwill. So whatever extra amount we receive, that considered as goodwill. Like for example, sir at C, capital 1/4 share, he bring 8,000, that means total share is 32,000. But actual capital is 22,000. So hidden goodwill is 10,000. That sum also we had complete. Right? So this is hidden goodwill concepts. Everything is done. And you remember, and you just try to understand, we will cover each and every part. Small part also we are covering. And not only for this lecture, but also for the future, because this notes can help you to revise anytime. Whatever you learn, everything we have in record, so we can revise it anytime. Okay? Now retirement of partner. That I just told you that retirement of partners is nothing but same as partner admission only. But here partner goes out. That's why we pay for him for capital, for his goodwill, share of goodwill, right? If we have money, we can pay. Otherwise, remaining partner can bring cash for paying of this money, or maybe we consider his loan. Means we transfer into his loan account, right? Go ahead. In case one partner goes out from the firm, so we will the admission procedure. We will reverse the admission procedure. We will reverse. Actually, it's a reverse. We will reverse the admission procedure, right? That is, we pay of the retiring partner his share. If fund is not available, share, right? If fund is not available, then we will transfer share to loan. Then we transfer his share to loan, right? And goodwill treatment are same, that is raised from old partner PSR, including new partner retirement and write off from remaining partner in new PSR. So this is what goodwill treatment are same, that is raised from old partner PSR, including retiring partner, right? And write off from remaining partner in new PSR, right? That we have discussed. So we have to do just raise goodwill, write off goodwill raised from the old partner, including the retiring partner, and write off by the imbalanced partner which is remain in the books, right? Accounting treatment same as in admission, that is we have to prepare evaluation account, partners capital account, and balance sheet after retirement, right? So as I told you that all treatment are same as we do in the admission only, right? So these are the notes which is we had written here, right? Now one more concept, that is joint life policy concept, which is help in case of death also and in case of retirement also. So now make the heading joint life policy. Then we read the question. Okay. So joint life policy. First of all, what is joint life policy? What is joint life policy? So in simple word, joint life policy is with taking life policy, like we take LIC, life insurance policy, right? Like we take LIC, same way partnership firm take policy for all partner life. That is called joint life. Means any of partner died, then all partner will get some amount from the insurance company, right? So joint life policy means policy for all partners, right? Now that premium is paid by partnership firm. Means for joint life policy, premium is paid by partnership firm. But once partner retire or anything change in the partner, in this case, they say your joint life policy will not more. Why? Why did not more? Because change in the joint life policy is not allowed. So what we have to do? We have to just cancel that joint life policy. So now joint life policy is like a life policy, but it is taken from the all partner together. Okay, so I just write it's taken by firm for all partners life. Now any of one partner die, then firm get joint life policy amount, which is distributed among all partners. You say, sir, we should give to death partner only because of death partner whoever died, because of them only we receive the money. Yes, it's correct. But premium is paid by the partnership firm. So premium is paid by all person, all partner. So definitely benefits should also given to all partner. Whether one partner is dying. So that is a question. Once any partner died, then we receive the insurance policy. But if partner is retired, then it may be surrender. Otherwise, it may be cancelled. Barabar? So, but if partners retire, then maybe it will cancel. Then it may be cancelled. Or we can keep it separate if there is option. Then only the retiring partner part will be lapse, remaining will be continued. But if separate is not there, then full policy will be lapse. But once policy lapse, we get some money. That is surrender money. Barabar? And we get surrender money. Because whatever premium we had paid as per the insurance term, some money we receive as surrender money. So if we cancel the policy because of retiring partner, then we get the surrender money. That surrender money we should distribute it among partners, right? And whatever money we receive should be distributed among partners in old PSR because it's old policy. Now, if we distribute in old PSR, fine. But what's happened? Sometime that joint life policy is already recorded in the books. Means we had already recorded. We had already distributed it at the surrender value. Then what we do? Subject to if joint life policy is already recorded in the books, it means it's already distributed. So then we prepare joint life policy account and any difference will be only distributed. Means if we have already joint life policy account in the books, in this case, we will make the joint life policy account and check how much already distributed and how much is received. If anything extra we receive, that will be distributed now. Means we will not distribute anything. If suppose same amount we receive and same amount already recorded. So what I am saying, if same amount is distributed and same amount is recorded, in this case, if same amount is distributed and same amount is recorded, in this case, no need to distribute anything, right? If we have already joint life policy in our books, that means we had already opened the account joint life policy in our books. So we make the joint life policy account and find the balance. Whatever balance will be distributed among partners. And if there is no joint life policy, then what we do? Then the entire amount, entire amount we receive, will be distributed among partners. How to distribute? That is whatever money received, that is account debit to partner capital ABC in their profit sharing ratio, because premium is paid by the firm. Okay, so I repeat once again, joint life policy is what? Taken for the all partner life safety. If any partner died, they get the money. If partner retire, they may be surrendered the joint life policy. Then whatever money we receive should be distributed among partner. But if that amount already in our books, that is, we had already maintained our books, we can say joint life policy account are maintained already in our books. That means we have to prepare joint life policy account and then check whatever balance in the joint life policy account. Only that much part will be distributed, not entire amount we receive or receivable from joint life. Okay, same thing written here also. You can read. Partnership firm may take joint life policy for security of partner's life. Its premium is paid by the partnership firm, and if any partner die in near future, then partnership firm will get matured amount on the date of death. It will be distributed among all partners in their profit sharing ratio. Barabar? Now surrender value concept they are also discussed. If no one is dead, but partnership firm went to surrender the joint life policy, then in this case they will get some amount known as surrender value, and again it will be distributed among all partners, because whatever money we receive, whether surrender amount, whether full amount or maturity amount, that should be distributed among all partners, right? If joint life policy already recorded in the books, that means joint life policy already account we have, balance sheet, then we should prepare joint life policy account, and whatever balance sheet remain, it should be distributed among partners. Means we prepare joint life policy account. If already joint life policy are there, then whatever balance remain will be distributed among partner in their profit sharing ratio. This is a treatment for joint life policy, right? Then general entry also they had mentioned. Profit and loss account debit to cash for premium paid. Joint life policy surrender amount we receive, bank account debit to joint life policy. Joint life policy maturity amount we receive, same entry will be passed, right? So joint life policy amount distributed, so joint life policy account debit to partner's capital account, and that's all. Okay, so joint life policy, once we paid premium, that is premium paid to P&L account debit to cash bank. Once we receive the joint life policy money, that is bank account debit to joint life policy account, that will be distributed to all partners. So joint life policy account debit to all partners in their same ratio. And if we have already joint life policy account, we make the ledger and we get the balance from the ledger. That only will distribute. Okay, understood. So let's do the sum of retiring partner. Okay, first I open the book. Retiring of partner, right? Then last death of partner, then our partnership get over. How to calculate new ratio? So new ratio will be just like after retiring partner, whatever the balance ratio become, it will be considered new ratio. Yes or no? Very good. If we do not have money, then we can transfer it into loan account. 8.86, right? So answer to question number 1, 8.86. 8.86. Illustration number 1, AB वाला फिल्टर IPCC वाले बच्चे हो तो आपकी बुक में देख लीजिए कहाँ पे है ये. Just 5 minutes. Yes, friends. Now, let's do this question. A and B are partner in the business. Profit sharing ratio in the 3/4 and 2/5. Sorry, 3/5 and 2/5. Their balance sheet as on 1st January 2015 given below. 1st January 2015. Okay. Capital AB. Reserve account, trade payable account. So reserve also there. So that reserve need to distribute to old partner in the old PSR, including retiring partner, right? Then plant and machinery, inventory, trade receivable, balance at bank, cash in hand. Okay. B retiring from the business. The business owing to illness and A takes it's over. The following evaluation was made. Now there are two partner only and one partner is retired. That means now it's not partnership firm. Now it's become proprietorship concern. But anyway, that is not a matter for us. We have to just retire that partner and whatever the his share we have to settle. The goodwill of the firm is valued at 25,000. Depreciation, plant and machinery by 7.5% and investment, inventory by 15%. This is not depreciation, it's a revaluation. It's a revaluation. Indirectly, it's a revaluation. Then doubtful debts provision is raised against trade receivable at 5% and discount reserve against trade payable is 2%. So these are the revaluation part, right? Generalize the above transaction in the books of the firm and close the partner's account as on 31st March on 1st January 2015. Give also the opening balance sheet of A. So they had asked general entry, partner's capital account, and balance sheet. All things they had asked. But if we make proper way, that is revaluation, revaluation, partner's capital account, and balance sheet. Right? Let's start. Answer to question number 1, page 8.86. First, revaluation account. Then partners capital account, partner AB, then opening balance sheet. Okay. So let's do the first part. Whatever they had given, just go ahead. Goodwill of the firm value 25,000. So what we should do, goodwill raise and write off, so that goodwill is not shown in the books. So working note number 1. Adjustment for goodwill. Right? How to do adjustment for goodwill? Goodwill raise and write off. So make the 2 column AB. Goodwill raise, that is credit with the old PSR. What are old PSR? They intimate us now. 3:2, right? And B is retiring. 3:2. How much goodwill? Goodwill is 25,000, right? 25,000. So 25,000 will be divided, distributed in this 3:2 divided by 5 into 3, 15,000 and into 2, 10,000, right? Now goodwill write off, because we don't want to show in the goodwill books. Debit. Now there is only one partner, so entire 25,000 will be write off from A, because now we retire. That means we will not share anything for written off. So 10,000 debit and 10,000 credit, and it will be A capital account debit to B capital account 10,000. Is it clear? Perfect. Now, what to do in the partner's capital account? So we just write first balance brought down. Balance brought down. How much balance is A and B? 20,000 and 15,000. 20,000. That is balance A and B. Now by A capital account, we'll write in B column 10,000 because B is retiring, so he will pay to A capital account. Sorry, to B capital account, we'll write in A column 10,000. So that entry we had passed for goodwill that we had provided effect. Next, reserve account. So reserve will be distributed among partners. So by reserve account 3:2 में will distribute how much reserve? 15,000. So 15,000 divided by 5. So it's become 9,000 and 6,000. Right. Next, depreciation on plant and machine, that is evaluation part. 7.5%, inventory 15%. Plant and machine is for 20,000. So revaluation debit is loss to plant and machinery. 7.5% on 20,000. To inventory 10% on. Sorry friends. Yes. So 20,000 and inventory is 16,000. So 10% on inventory, 15% on inventory, right? Not 10%. 15% on 15,000, right? So this is 20,000. This is 16,000, not 15. We charge 15% and 7.5% on 20,000. So 20,000 into 7.5%. 1,500 and 16,000 into 15%. 2,400. Right? So this is the valuation of plant and machinery, 7.5% and inventory 15%. Next, doubtful debts provision. Rates against trade receivable at 5% and the discount reserve against trade payable is 2%. So trade receivable 5%. So 2 RDD 5% on 15,000, 750. By payable 2% reduce. So 7,500, 2% of 7,500. 150. Right. So that is evaluation part. Everything is done. Yes. So we can also pass the generality for the evaluation part as well as provide the balance sheet effect, so that all things are done, right? So let's do the evaluation balance sheet also. What we write? First item is plant and machinery. Plant and machinery is how much? Just put that information. Hello. Haji. No. Thank you. Yes, friends. Sorry. Now plant and machinery is how much? It's 20,000. So on that 20,000, we will reduce 1,500. That is 7.5% of 20,000. It comes to 18,500. Right. Next, inventory. It's 16,000 less 1,600. It comes to 14,400. Right. Inventory 16,000 less 15% 2,400. Not 1,600. 2,400. On 15% charge, right? So 2,400. 16,000 less 15%. 13,600. Next, RDD on debtors, that is 15,000. So debtors saying I think friends it's hang. Yeah. Now inventory. Next, trade receivable. Trade receivable 15,000 less 750 comes to 14,000. Right. Then payable. Payable is how much? 7,500 less 150. 735. Right. That's all. Now we pass the entry for these things. Loss will be debit, so revaluation account debit. To plant and machinery, to inventory, to debtors. Right. 1,500 to 400 and 750. 750. Total is 0, 5, 9 or 7, 5, 4, 9 and 7. 16, 3, 4, 4, 6, 5, 0. Right? 4, 6, 5. Then payable is debit. Payable account debit to the valuation 150. Right? I think all the valuation part we had done in the balance sheet as well as in the journal entry. Everything is done. Now close the account so that we get the balance. Let's close. First we close the valuation account so that we get the valuation profit or loss. Here this time is the profit loss. So by partner capital account AB, because this will share by everyone, 1,500 plus 2,400 plus 750, 4,650. Less 150, 4,500. right? It will be distributed in 3:2. That is their profit sharing ratio. 3:2 divided by 5 into 3, 2700, 1800, right? So, to revaluation account 2700, 1800. Now, to what they say, it will be transferred to bank or it will be paid. Transaction book of the firm and close the partner's account of 1st January. Give also opening balance sheet of A. So B retired from the business of less and A takes it over the following revaluation. So we consider that this amount is transferred to his loan account because he don't have the money to pay. So we'll transfer to loan account only, right? So we assume it's transferred to loan account. So to B's loan account, right? And remaining is to balance credit. 29,000 this is 25, 31,000, 31,000 less 1,800, 29,200 and 29,000 minus 10,000 minus 2,700, 12,700, 16,300, right? In the balance sheet, H capital 16,300, B's loan now because he now no more partner 29,200. Clear? Everything is done. Now take the total of balance sheet 29,200 plus 7,350. What are the answer, friends? Tell me first. 52,850, 18,500 plus 13,600 plus 14,250, 46,350. That means something is balanced. Let's check. Plant machinery, inventory, trade receivable, balance at bank and cash in hand. Both are not written at here. Bank and cash in hand. 6,000 and cash in hand how much? 500. Plus 6500, 52,850. 52,850 is the balance sheet total, right? Because in the question they had not mentioned anything for the cash bank, so we write same cash bank balance as it is previous. Okay. Thank you, sir. So now balance sheet get over and sum also can complete. Let's check the balance sheet answer. General entry also we had passed 52,850. C capital 16,300 and B loan 29,200, right? Yes. Good. Next question. Question number 2. F, G and K. Any doubt, any question, friends? I hope no problem, no doubt at all. F, G and K were partners sharing profit and loss in the ratio 2:1. K wants to retire on 31st December 2015. Given below is the balance sheet of the partnership as well as other information. Okay, there are 3 partners, 2:1 is the sharing ratio, and where who want to retire, F and G agree to share. Where who want to retire? K want to retire. Means last partner want to retire, right? So now F and G agree to share profit and loss at the ratio 3:2. We just see previous is 2:1. If they gain in the existing ratio, then the new ratio should be 2:2. But new ratio is 3:2. That means gaining ratio is different. So we have to calculate gaining ratio in case of retiring partner equal to new ratio minus old ratio, right? So we can calculate the gaining ratio, and in gaining ratio only goodwill is shared or goodwill is beared by the remaining partner, right? Value of the goodwill is taken to be 50,000. Sundry fixed assets are revalued upward by 30,000 and inventory by 30,000. So sundry fixed assets revalued upward by 30,000 and inventory by 10,000. So these are upward revaluation. Next, bills receivable dishonored rupees 5,000 on 31st December 2015, but not recorded in the books. Dishonored of bill was due to insolvency of the customer. So it means what? This is indirectly showing dishonored, but actually it is bad debts because the customer get insolvent. So now he will not get money back from this customer. That's why we should consider it like a bad debts, right? So we can write it like a revaluation loss, bad debts. Next, dishonor of bill due to insolvency. Okay, F and G agree to bring sufficient cash to discharge claim of K and to make their capital proportionate. Underline कर लीजिए capital proportionate. That means what? They want their capital proportionate after retiring of K, and also this time K will pay off full. Like in previous question, we had considered beach loan because we don't have the fund. But in this case, they say it is pay off. So no problem. We will get cash, something by which we can pay K amount also, and our capital become proportionate also. Okay. Also, they want to maintain rupees 75,000 bank balance for working capital. Okay. So that is 75,000 they want bank balance. That means this time bank account is also prepared. Also need to prepare because whatever shortage of cash will also bring by the remaining partner. Not only paying for the K, but also maintain the balance in the capital account 75,000. In the cash account 75,000, right? So we have to maintain balance in bank account 75,000, as well as we have to pay off for Mr. K, right? Okay. Required past journal entries and draft the balance sheet of Messrs. F and G. Also prepare a capital account of partners and draft the balance sheet of Messrs. F and G after K retires. So why they want two-time balance sheet, past journal entries and draft the balance sheet of Messrs. F and G. Also prepare capital account of the partner and draft the balance sheet of Messrs. F and G after K retiring. So definitely before K retiring balance sheet is given, we have to prepare only after retiring, right? So no problem, we'll make the balance sheet after retiring. They had asked twice, but the meaning of that is same, right? So let us start. We'll do that in the same way. Here capital proportion also there, so we have to apply that capital proportion also with bank balance maintained at 75,000. So we have to prepare bank account also in addition, right? So revaluation account, partners capital account, balance sheet, as well as cash account. 4 account we need to prepare, and on that basis we can pass an entry also, right? So let's start. Answer to question number 2. Another page number 8.888. Right? Now revaluation account, will be prepared like normal. Then partners capital account. There are 3 partners, make the 3 column. Partner name is FGK. FGK. Where K is going to retire. So we can cross the K, right? Then particular. Then cash account. Where opening balance and closing balance are fixed. To balance brought down is the opening balance. What is the opening balance? 50,000. By balance carry down, 75,000 we want to maintain the balance. So balance carry down I also mentioned here, right? Remaining thing we will fill. Balance sheet after K return, right? As on the same date, the balance sheet, right? So 31st December 2015 or whatever date, right? 50. Fine. Balance sheet also same way, right? Now let's start with the first adjustment. I told you that we will start with the first entry and finish the fact whatever required so that full sum can come within a one reading only. Otherwise, every time we have to read for one part, another for second parts. It take the time, right? So if we do everything together, then it not take the time, right? Now let's do. First, their profit ratio is 2 to 1 and new PSR is 3 to 2. That means we have to calculate the gaining ratio, right? So working note number 1. Calculation of gaining ratio. Old PSR 2:1, or you can write the name FGK 2:1, right? FGK 2:1, right? And new ratio between only F and G is 3:2. Therefore, gaining ratio will be new minus old, right? So this is 2/5. Sorry, new ratio is 3/5. 3/5 minus 2/5, right? It's become 1/5. And for G, 2/5 minus 2/5, 0. That means only F is gaining. For K share, G is remains same as before retiring as well as after retiring, right? So G will remain same. We have to use F only. Is it clear? So now F 1/5 and F is gaining from K. So entire goodwill share will be paid by F to K because he is the gaining partner. As we discussed at the beginning only, whoever gain have to pay for goodwill to the sacrificing partner, and K is definitely sacrificing because K is retiring, so he will not get any more from the firm. So whatever his share is entire he is sacrificing, and who will take this share? The F is taking this share, right? So let's do we go ahead. Capital is the capital balance. We transfer first capital balance so that we can go ahead, right? So capital balance is 120, 80 and 60, right? So by balance brought down 120, 80 and 60. Also distribute reserves so that we not forget to distribute. Reserve is how much? 10,000. This is one table actually downside. So reserve is 10,000. So 10,000 will distribute in between 2:1. That is old PSR. So 4,000, 4,000 and 2,000. Clear? Okay. Further, F and agree to share 3:2 that we can go to the gunning ratio. Goodwill taken. Value of the goodwill is taken to be 50,000. So now we take the goodwill treatment. So now what we should do? Goodwill of the firm 50,000. Therefore, K share, that is retiring partner, how much share? 50,000 into 1/5 equal to 10,000. Right? So what we should do? 10,000 F have to pay 2K. So F capital account debit 2K capital account. Right? 10,000, 10,000. That's all. So in the capital account, in F account, we write debit side by F capital account. In K, we write 10,000 to F capital account. Sorry, K capital account. In F, we write debit side 10,000. So first part goodwill get over. Now Sandeep fixed assets valued upward by 10,000 and inventory by 10,000, 30,000 and 10,000. So inventory 10,000 upward and revaluation in fixed assets 10,000, 30,000, right? So we write in the valuation account by fixed assets 30,000 and by inventory 10,000, right? So this is revaluation effect. Now other effect we can also give in the balance sheet so that we get complete effect of this transaction. But we complete first this also. Bills receivables dishonored 5,000. Dishonored due to discharge means due to insolvency. So this 5,000 also going to bad debts, right? So 5,000 we do in the bad debts. To bad debts 5,000, right? So now what we do? Balance sheet we write fixed assets existing balance 1,50,000 plus 30,000 increase. That means 1,80,000 is the balance of the fixed assets, right? In same way, inventory 50,000 plus 10,000, right? So inventory 50,000 plus 10,000 because it's increased by 10,000. Then debtors, or you can say trade receivable. These are 460,000 less 5,000 due to bad debts. So 55,000 the balance, right? These not 60,000, not 70,000. These are 70,000. So now this amount is 65,000. 70,000 minus 5,000. Clear? Okay. Then F and G agree to bring sufficient cash that we have to find from cash account, that they pay to K also, and they get 75,000 balance in the bank balance also, right? So now I think everything is done. Trade receivable including bill receivable 20,000. That is we had done including trade receivable. Now bank account balance we had transferred. Now reserve we had distributed. Now trade payable. Trade payable also write the same figure 50,000. Trade payable 50,007. Right. Now bank balance they mentioned that 75,000 should be remain in the bank. Now what we should do? We should close the revaluation account so that we can calculate what the share of the profit of retiring partner. So we can pay off that share so that we can identify how much cash shortage. Right? So let's close it to bank. First close. Okay, before it we should close this revaluation, otherwise revaluation profit get leave. 40,000. 40,000. Profit is 35,000. 2 partner capital account FGK 221. So by 7,000, 14,000, right? So this will also be right here by revaluation profit and loss 14,000, 14,000 and 7,000. Now what is the balance of this? 60 to 10, 7, and it is 79,000. Now their balance we have to calculate. Balance carry down, and that balance we created. First we transfer, then we will identify how much cash is shortage. Right. So first what we do, 79,000 we pay to the cash account by K capital account. 79,000 we had paid to capital to K. Right. Now whatever the shortage will be bringing by new partners, that is 1,54,000. How much shortage? 1,04,000 to remaining partner. Now for that we make the working note. Calculation of proportionate capital. Right. For that shortage of cash 1,04,000. Right. So 1,04,000 we have to get from shortage of cash. Whatever balance they are going on at present, that balance also we have to keep with the firm, because they not say they will bring anything extra. They say they not withdraw anything extra. They say ki they have to maintain cash account balance 75,000. Right. So whatever the cash shortage they will bring. So 1,04,000 they will bring. But how much existing balance that remains same? So what is existing balance? So either we can close it first so that we can calculate the balance, and bank will transfer later. Good. So that first calculate the balance. According to we know the how much balance present, right? 80,000, 4,000 and 14,000. So this comes to 98,000. Then 1,20,000, 14,000 and 4,000. This comes to 1,38,000. Like 38 minus 10 to 1,28,000, and this is 98,000. Right. Now 128, 98 right here. Balance 128, 98. We can say existing balance of F and G. Therefore, total capital should be, how much total capital should be? Total of these things 1,04,000 plus 1,28,000, because 1,28,000 already with the partners, and 98,000. So 3,30,000 should be total capital. the total capital should be distributed among F and G in the ratio of 3:2. Right? So divided by 5 into 3, 1,98,000, and into 2, 1,32,000. So this is overall amount which total capital should be there, right? So 1,98,000 and 132 should be capital of F and G. Now what we write? 198 and 132. H. So we go further one more step. How? In this way, so that we can make the proportionate capital. By balance brought down will come on the next year, not next year, next part, 98,000. Then to capital balance carry down. That should be 132, not 132, 132, 198 and 132. 198 and 130. So 198 and 130. Whatever shortage will be that bringing by partner. So 198 total. What is the shortage? 70,000. They will bring. Right? 132. 34,000 they will get, right? So A will bring 70,000, B will bring 34,000. So we can write in cash account this bifurcation of 1,04,000. F and G. F will bring 70,000 and G will bring 34,000. Total must be 1,04,000 because shortage is 1,04,000, but that shortage we had not distributed among partners. That shortage is calculated through proportionate capital. So we calculate first proportionate capital. For that, first we calculate the total capital. Like in previous question, they had given the total capital that should be the total capital. But in this question, they had not given the total capital. We have to calculate total capital by using whatever the shortage of the firm. So that shortage amount 1,04,000 plus whatever the existing balance, all together become the total capital. Then total capital we have divided into proportionate, that is PSR 3:2, 198 and 130. But the balance is 128 and 98. That's why whatever the shortage, that is 70,000 by A, not A, F, and 34,000 by G, 34,000 will be bringing by F and G. Okay, so now make the balance sheet final, must be tally. Write the capital account. Capital account F and G 198 and 132 comes to 330, right? And the balance thing we are already done. Cash bank balance we are already done. So now balance sheet must be tally 3,80,000. The total of this 1,80,000 plus 60,000 plus 65,000 plus 75,000. This comes to 3,80,000. 3,80,000. Account tally. Okay, understood, friends? Any doubt, any question, please ask. So this is what proportionate capital as well as our cash account balance also we had maintained 75,000. So cash shortage first we calculate, then we calculate the proportionate capital. But nothing is special. If still you have doubt, you can again see the lecture, right? Okay. So everything is done in this question. Let's see the answer what they had given. C capital, that reserve we had not passed the entry, you can pass the entry for reserve also, and for evaluation also you pass the entry, right? And whatever the bank they had bring, we had not passed the entry, you please pass entry for all these things, right? For cash we can pass the entry. okay, at least. So we had passed entry only for goodwill, that is C capital, this F capital account debit to K capital. And for cash we pass the entry, that is K capital account debit to bank, 79,000 he get from the firm, and at the last bank account debit to F capital to G capital, 1,04,000, out of that 70,000 bringing by A and 34,000 by B. Right? So this is overall entry for cash, but we can pass entry for evaluation like we had passed previously. We can also pass entry for this capital adjustment, capital proportion. That capital proportion entry is automatically passed basically because of this cash P and G bringing, that will automatically capital proportionate. Now only for evaluation, profit and loss, we need to pass the entry for evaluation item as well as for evaluation profit and loss. These are the two entry: evaluation loss, then evaluation account debit to assets name, and evaluation profit, then assets name account debit to evaluation account. Right? And whatever profit will be distributed to partner in their profit evaluation. Clear? Okay. Next. Balance sheet also 3,80,000, 198, 132 is a capital. Right? Everything is done. Like this. Right? Balance brought down first to calculate, then 79,000 you had paid, and this balance you had calculate in proportionate in the separate part. So you make the two part like this, right? The same way we had also did, but we don't have the place. But still, we keep in our mind that whenever they are proportionate capital and their total capital is not given, so we use this way only. First we close balance brought down, then we calculate adjusted capital. Okay. Now, next, illustration 3. ABC were in partners sharing profit and loss in the proportion of 5:4:3. Balance sheet of the firm as on 31st March 2015 was agenda. A. Capital ABC, net payable, goodwill. Goodwill already given in the books. It means goodwill account is already open. Goodwill account is already open. Right? Pictures, inventory, trade receivable, cash. Okay. A had been suffering from ill health and gave notice to his wish to retire. Okay. An agreement was therefore entered into as on 31st March 2015, the term of which were as following. Okay. The profit and loss account for the year ended 31st March 2015 was shown a net profit. This is on 31st March 2015, and the balance sheet given is on 31st March 2015. Okay, so 31st March only he had decided to retire. I thought date is different. Which shown the net profit of 48,000 was to be reopened. Okay, means already profit distributed was reopened. B was to be credited with 4,000 as bonus in consideration of the extra work which had devolved upon him during the year. Okay, so they say that 48,000 profit which is already distributed will be reopened, and B was to be credited 4,000 with bonus. Okay, means before retiring they have the new condition. No problem. The profit sharing ratio was to be revised from 1st April 2014 as 3:4:4. Means previous profit sharing ratio is, what is the previous profit ratio is 5:4:3. They want to revise it for 5:4:3 is to revise to the 3:4:4. Means previous ratio is 5:3:3. Now new ratio is 344. Okay, so it is something like a adjustment of profit. Means whatever profit they had already distributed, now we want to reopen it. So for that, what we have to do? We have to prepare. What we have to prepare? We have to prepare one P&L appropriation account, which is previously distributed, which is reverse, and new should be implemented. Because previously PSR is different, new PSR is different. Previously we had not given bonus to the B, but now we have to given the bonus to the B. Okay. Again, goodwill was to be valued at 2-year purchase of average profit of the preceding 5 years. Okay. The fixtures were to be valued by the independent valuer. A provision of 2% was made for doubtful debts, and the remaining assets were to be taken at their book value. These are the term conditions, right? But what is the goodwill value? What is the independent valuer has valued? That is not a given. That given in the niche, in the downside, right? The valuation arising out of the above agreement were goodwill 56,800. Means they had mentioned how to calculate the goodwill, but they had valued the goodwill 56,800. Means no need to value the goodwill. Like we can calculate the goodwill, like we had did in the admission, or we had did in the valuation of goodwill part. But they had calculated goodwill themselves, and they had given directly to us 56,800 the goodwill value. Okay. Then fixtures 10,980. B and C agree as between themselves to continue the business. Okay. B and C agree as between themselves to continue the business. Okay. Sharing profit in the ratio 3:2, means new PSR is 3:2, and decided to eliminate goodwill from the balance sheet. Okay. Means goodwill is already there in the books, but now goodwill value is 56,800, but previously I think goodwill is 40,000 only. So whatever additional part will be revalued, given to the old partner. But now they want to eliminate the goodwill value entirely, not this only 40,000, but 56,800 also. That means 56,800 is total goodwill, out of which 40,000 is existing, and 16,800 is the new. Right? Okay. 3:2, and decided to eliminate goodwill from the balance sheet to retain the fixtures on the books at the revised value, and to increase the provision for doubtful debts to 6%. Okay. So this is the all the valuation part they had mentioned. Required. Submit the journal entries necessary to give effect of the above transaction, and draw up the capital account of the partner after carrying out all adjustment entries as shared above. Means they had not asked the balance sheet, but we prepare balance sheet as well, right? So we'll make capital revaluation account, capital account, and balance sheet, and also pass journal entry. Okay, so let's start. आप लोग पहले करिए, मेरे से पहले आपका होना चाहिए, right? So try your own. It will give more value, right? So I write answer to question number 3. Or the page number, friends? 8.90. Yes, 8.90. Answer to question number 3, 8.90. Now we'll make revaluation account, then partner capital account, also we need to prepare P&L adjustment account, right? How to prepare P&L adjustment account? Because they had mentioned they reopen the P&L account 48,000, so we'll do it, right? Then we prepare balance sheet after retirement. Okay, or maybe after retirement. So balance sheet will be as usual, like we prepared. Okay, let first you try. Yes. Okay, friends, let's start. I hope you had did something, right? Let's do. First, we transfer the capital balance 135,930, right? So 135,930. ABC. My balance brought down 135. 930. Very careful, friends. Amount is little different. 95,120. 95,120 and 61,170. Right? Okay. Then next, they have opened the account, right? So what we have to do? A had been suffering, so A is going to retire. So we can write in a column A, B, C. They are going to retire, right? So A is going to retire. Now what we should do? Next adjustment, and agreed was to transfer the following, right? They reopen the profit and loss account of 31st March 2015, that is 48,000. So what we should do? We have to reopen, that means 48,000 first we have to reverse. So what we should do for that? To profit and loss of 1415, 48,000 in the old PSR, that is, what the old PSR? 543. So in 543, it should be reversed. Sorry, friends. 543, 543, it should be reversed. So 48,000 divided by 12, right? 48,000 divided by 12 into 5, 20,000, because they want to reopen it, into 4, 16,000. So first we have to reduce, then only we can open it, na? 12,000. So now we open it. By net profit brought down 48,000. We are making P&L appropriation account, or you can say P&L appropriation account, right? P&L appropriation account, right? It's need battery also. So net profit got down 48,000, right? To bonus, to whom we have to pay the bonus? They say reopen, and B was to credit with 4,000 as bonus. So okay, so to B 4,000 bonus will be given. Then to partner capital account A, B, C in the new ratio, that is 344. 344. Okay, so first we credited bonus 44,000 by net profit adjusted. Whatever the balance will be distributed among all partners in the new PSR, which is they had decided at the time of retirement, right? 44,000. So 44,000 divided by, 437 or 411. 44,000 divided by 11. So 4,000 into 3, 12,000 into 4, 16,000 into 4, 16,000. So that should be the profit. So 12,000, 16,000 and 16. Clear? So basically the A getting the more profit, it is reduced because of A retiring, right? So they are mutually agree, so no problem. What we had did, we had first cancelled that profit, whatever they had already distributed, that is 20,000, 16,000 and 12,000. Now we had reversed that profit as per the new their provision, that is they say it should be distributed among partner as per the this new ratio, and we also give the bonus to B because he devoted the extra time for the work, right? Okay, next. That is this adjustment number 1, right? It's a totally new adjustment where we have to open the existing profit, right? So we had open, no problem. Third part, goodwill was to be valued at 2-year purchase of average profit of bridging 5 years. Now for that we need to prepare step 1 to 5, 1 to 7, but no need because they had given the goodwill value, right? The fixtures was to be valued by the independent valuer, that is also valued, and the provision 2% to be made for doubtful debts, and remaining assets were taken at their book value. So doubtful debt we can take 2%. How much the debtors? Trade receivable 93,500. So 2 bad debts provision 93,500, 2%, right? 93,500, 2% on it, right? 2%. So 93,500 into 2%, 1870. Immediately write in the balance sheet also, so that trade receivable 93,500 less 1870. So 93,500 less 2%, 91,630. Perfect. So trade receivable is done. Next adjustment, the goodwill are valued, agreed to value 56,800. Now we have already goodwill account, that is 40,000 showing. So what we should do, we should prepare the goodwill account, or we can use through evaluation also, but we make goodwill account separate. That is only good, right? So make the goodwill account separate. One working note number 1, goodwill account. Normally we should make adjustment for goodwill, or we are making goodwill account this time. Balance brought down 40,000, right? Now what they say, they had valued that goodwill 56,800, right? So to goodwill increase by how much? 56,000. The value arising out of the above agreement, but goodwill 56,800. So 56,800 minus 40,000, so that is increased by 16,800. That is partners capital account, old PSN, right? We can write goodwill account debit to partners capital account ABC, 16,800. Now what ratio we should distribute? So their PSR is actually this 543, what they say, extra work which had devoted upon him during the year, the profit sharing ratio was to be revised from 1st April 2014 as this. So from 1st April, this profit sharing ratio was revised. That means now PSR is 3:4:4, right? So 3:4:4, it should be distributed 3, 4, 4. 16,800 divided by 11 into 3, 4, 5, 8, 2 into 4, 6, 1, 0, 9. 6, 1, 0, 9. Right? Now what we have to do? We have to write off the goodwill also. So when we pass partners capital account debit, where only the remaining partner will use, that is partner B and C, to goodwill account, right? Entire goodwill we are going to write off, that is 56,800. Now in which ratio between A and B, B and C, they agree to leave 3:2, new ratio, right? 3:2. So indirectly what we are doing, we are raising the goodwill, but today, in this case, goodwill is already raised 40,000, so 16,900, 800 is the new amount which we are to raise. But write off, we want to entire 56,800 by remaining partner, that is B and C, right? So B and C 56,800 divided by 5 into 3, 34,080. Understood? What we are doing, we are writing off the goodwill, entire goodwill, because some goodwill is already there in the books. So now we have to raise the remaining goodwill, that is 16,800, but entire goodwill we have to write off. So entire goodwill is 56,800. So we have to write off 56,800. 22,720. So in goodwill account, what we do? By partner capital account, B and C, 34,080 and 22,720. Okay, so goodwill account get tally, and this capital is also used by A, B, C in this amount: 4582, 6109 and 6109. So in short, goodwill account we had prepared just to show the goodwill account. So 40,000 already balanced there. If 40,000 balance is not there, then we no need to prepare goodwill account. But by making goodwill account, it's tally now, there is no balance in the goodwill account, right? So provide that effect in our partner's capital account as well as in the partner's capital account by goodwill when it is raised. At the time of raise, what the amount? $34,080 and 20,720. 4582, 4582. Then 6109, 6109. Right. 2 goodwill written off. $22,720, 34,080, 34,080, 34,080, and 22,720. Right? This is the goodwill effect. Understood? I just just come friends in 10 minutes. Yes, friends, sorry. आज पोलियो की दवाई थी, मेरे बेटे को पोलियो की दवाई देने गया. So I hope goodwill adjustment is clear, because this goodwill adjustment is something existing goodwill are there, but we are opening this goodwill extra, right? So this is the goodwill treatment. Now we go ahead with the next part. The evaluation, fixtures 10,980. What the exactly value of these pictures? 8,200. So its value is 9,000, 10,980, right? So now fixtures evaluation. So we come on the evaluation account. By pictures 10,980 minus 8,200. So value increase is 2,780, right? So we write immediately fixtures in the books also, in the balance sheet also, so that balance sheet get tally. Pictures 10,980, right? So 10,980 is the new value. Next adjustment, goodwill done, fixtures value done, and new PSR is still issued to, and decided to eliminate the goodwill from the balance sheet. That is fine. To retain the fixtures on the books at the revised value and increase the provision for doubtful debts to 6%. Okay, what they say? And decided to eliminate goodwill from the balance sheet. Okay. To retain the fixtures on the books at the revised value and to increase the provision for doubtful debt 6%. Means instead of 2%, they want to maintain at 6%. So what we have to do? But we have to do trade receivable 93,500. We have to charge 6%, not 2%. But here they say 2%. See, the fixtures were to be valued by the independent valuer, and the provision for of 2% was to be made for doubtful debts, and the remaining assets were to be taken at their book value. And they say increase the provision for doubtful debts is to 6%. Instead of 2%, it should be 6%. So what we have to do? That provision we have to divide not 2%. We have to make 6%. So it's become 5,610. So we written the balance sheet also 5,610. We subtract, this comes to 87,890. 87,890. Perfect. So 87,890 should be the balance. Is it clear? Okay. Now, anything else? Nothing. Submit the journal entry necessary to give the effect of above arrangement and draw up the capital account of partners' capital and prepare balance sheet. It is from our side, right? Balance sheet they had not asked, but we had made the balance sheet. Okay. So first, close this valuation account 5610 minus 2780 2830 by partners capital account ABC. In which ratio? In the new ratio, because they had revised 344. 3,344. So divided by 11 into 3, 772 into 4, 1029. 10. Right? So this is the valuation account also done. Partners capital account done. So transfer to partners capital account. To evaluation loss 772 1029 and 1029. Done. Okay. Now fill adjustment account already calculated and already done. They want proportionate capital. I think there no mention about proportionate capital. To balance carry down whatever the balance, just calculate carry down 135,930 plus 12,000 plus 4582. This comes to 10, 15, 4, 6, 7, 5, 12, 3, 4, 5, and 1. 152, 512. Right? You can take the total 135, 930 plus 12,000 plus 4582. 152, 512 minus 20,000 minus 772. 1,31,740. That should be transferred to loan, or we should pay what they say. Agree was that therefore A had been suffering from the ill health and gave the notice that the wishes to retire, and agree was that therefore retirement into 31st March 2015, the retirement this condition, right? And we can assume that draw up the capital account, so we keep it as a loan, right? So this is loan to loan 131,740. Okay, and their balance will be keep as balance carried out. So 95,120 plus 4,000 plus 16,000 plus 6109. 121, 229, 121, 229 minus 16,000 minus 34,080 minus 1029. 70,000 1. 2, 3, 8, right? 61,170 plus 16,000 plus 6109. 83,279. 83,279 minus 12,000 minus 22,720 minus 1029. 47,530. Perfect. So this is the balance of capital. Capital balance BC 47,530 and BH 70,120. 70,000. Right. 70,000. This comes to 1,17,650. Okay, and Ace loan 131,740. 131,740. Ace loan. Remaining item remains same as in the balance sheet. So let's say goodwill remain. Goodwill is no more. Pictures inventory 157,300. 157,300. Then trade receivable already done. Cash 34,910. Cash 34,910. We can give some cash to B also, A also. but nothing is mentioned about that. So we had entirely transferred to loan only, right? Now trade payable 41,690. Trade payable 41,690, right? 41,690 trade payable is done. Cash, everything is done. Goodwill is no more because goodwill we have written off entirely, and everything is done. So let's take the total of balance sheet. It must be tally. P&L appropriation account we had already transferred. That valuation, profit and loss we had already transferred, right? So everything is done. Now just take the total of balance sheet. It must be tally. Take the total of balance sheet. 170,650 plus 131,740 plus 41,690. 2,91,080. Right? Now this side also you can take the total. 87,890. 87,890 plus 10,980. 10,980 plus 1,57,300 plus 34,910. This comes to 2,91,080. 2,91,080. Okay, friends. So this is we had make balance sheet also in an extra, but general entry we had not passed. You can pass the general entry also. Age capital to transfer to age loan, that is 131,740. The valuation and the adjustment for the profit also you should pass the entry, right? And for goodwill we had already passed, right? So this is the your balance sheet, and they are not asked balance sheet, but still we had prepared. So we can cross some part of answer like P&L adjustment. They had distributed 44,000. Fixtures evaluation they had made, right? Goodwill account they had adjusted. Goodwill they had written off for 40,000. Then they had raised goodwill. Age capital and loan 132,760. 131,740. Okay, our loan amount is different from this. Okay. When for doubtful debt 3740, B capital, A capital to A capital, that is for goodwill. Okay. So that goodwill treatment 15,491. Maybe they had did some special way, because what we had did for goodwill, we had calculated the extra goodwill, right? Or previous goodwill they had written off in which ratio? 40,000 they had written off in which ratio? Oh, if they had written off in the previous ratio, that is 431, then their answer may be different. I repeat, that 40,000, if they had written off in the previous ratio is what? Given the question itself. That is 543. If they had distributed in 543, that means answer is different. And I think they had distributed in new ratio. That is 344, right? So 344 they had used. So I think answer should be same. But they had not written off entire goodwill. They had written off only 40,000. So because of that goodwill part, answer may be different. So we can give also a note for that, so that goodwill treatment can be done. Note, goodwill can be written off first, that is 40,000, and then we can further adjust goodwill. Then what the treatment, just for this information, we are doing that the treatment which book had did. First we write off the goodwill. What goodwill we write off? Only 40,000. So we write A capital account debit, B capital account debit, C capital account debit to goodwill 40,000, right? So 40,000 divided by what the ratio, new ratio? Three, four, four. 344. So 40,000 divided by 11 into 3, 10,909 into 4, 14,545. 14,545, right? So we had written off the goodwill 40,000. Then what we do for new goodwill, that is 56,800, we will do adjustment entry. How to do adjustment entry? That is goodwill raised and write off. ABC. Goodwill raised. How to raise goodwill? 56,800. New goodwill is 56,800 only, na? Yes. 56,800 will be raised by 344. Right? So 344 will raise 56,800 divided by 11 into 3. 15,491 4, 20,655 and 20,654. For one, and we'll give one less amount, right? Then goodwill written off in the new ratio. What the new ratio? 3:2. That is credit, this is debit. So 56,800 divided by 3:2, that is 5, into 3, 34,080, and into 2, 22,720. Therefore, net 15,491 is credit, 22,000 minus 20,654, 2066 debit, and this is also debit. 34,080 minus 20,655, 13,425 is also debit, right? Therefore, net entry will be B capital account debit 13,425, C capital account debit 2066, to A capital 15,491. Means if we do in this way, then first we write off the goodwill by 344, then we raise and write off the goodwill entire 56,800, because 40,000 we are already written off. So in this case, our entry will be this, and because of that, definitely answer will differ, right? So we can do this treatment also, as we had mentioned in note. That is, first we write off existing goodwill, that is 40,000. Then we do the treatment with the total goodwill, that is 56,800. But what we had did, we had make the goodwill account where 40,000 already there, so we had raised only 16,800. So 16,800 only raised new capital, right? Which is given to all partners, and write off entire capital 56,000 by A and B, B and C in the new ratio. So because of that, net effect in our capital account may be different. Okay, so friends, both things you can do, both are allowed. Book had did this thing, and we had did this thing. Means we had used goodwill account, and they had used write off first entire goodwill whatever given in the books, and then they had raised and write off the entire 56,800 goodwill. Okay. So anything we can do, we can write alternative. Alternative. Okay. So in alternative, you can do any of. Is it clear? Fine. So in this case, friends, our answer will be this. If we follow this, then answer will become this. You can see also, they had write off the goodwill 10,991, 10,909, फिर 14,554, 14,554, 545, 14,545, 14,546 बना दिया है, no problem. Then for goodwill adjustment, they had make this adjustment. That is 15,491, A capital credit, C. 15,491 A capital credit, and B and C debit with 13,425 and 2,066. 13,425 and 2,066. Right? So they had did this one. Okay, understood, friends, all of you? I think no question. Yes. Now, question number 4 of same. KLM are partners sharing profit and loss in the ratio 5:3:2. Due to illness, L wants to retire from the firm on 31st March 2015 and admit his son N in his place. So now it's a combination of retirement and admission together. So before reading this sum, we make the heading retirement and admission together. So new heading retirement and admission together. It's very simple, nothing special. We know retirement also, we know admission also. Right? So it's a all together part. Understood? But first we take the break. Okay? Then we do this. So now we have lunch break. And we'll come back by 3 o'clock. Okay? So we have the lunch break.
मनोज सर,
Yes, sir.
क्या करना है अभी?
Yes, sir. Can you hear me?
Yes, sir.
So now, sir, 3 o'clock we meet again.
Okay. अभी मेरे पास 2 बजे 2 o'clock.
Yes, yes. 2 o'clock is also in my watch. So 3 o'clock we'll meet again.
Okay. चलेगा सर. Bye bye.
Okay. Bye bye. Thank you.